Well, thank you for joining us. 2022 was a brutal year for the world, but especially so for emerging markets. Debt rose to a record level. The IMF said that, you know what, it's actually at a dangerous level. Some countries defaulted, currencies were slammed. We had the lira falling 30% after slumping 40% the previous year. Stocks and bonds tumbled at a double-digit pace. All of that on the back of an aggressive Fed wanting to rein in inflation, raising rates 300 basis points. Well, 2023 is off to, dare I say it, a hopeful start. Inflation seems to be easing. The dollar is not that mighty anymore. And China surprised the world, removed the Band-Aid, and now there's no more zero COVID policy. And that's prompting optimism for the rest of the emerging market world as well. So against that backdrop, where are the opportunities? Where should smart money go? And what are the risks? Of course, you talk about EMs, there are always risks. Let's start at the top. Leila, compared to 3 to 6 months ago, it does feel like it is pretty hopeful for EMs. Are we right in feeling that way?
Certainly, Haslinda. I think there are probably 3 elements that are determining the sentiment towards EMs. We've come out of a confluence of very serious problems which have devalued or created very negative valuations and a risk-off attitude towards emerging markets. The first is the US policy and whether rates will remain higher for longer and what happens to growth. The second is what happens to China. And then, of course, the third would be a sort of re-globalization, deglobalization concept. So as it regards the first, to the extent that we do have a more soft landing, which seems to be the general consensus, and growth starts to grow, starts to show positive signs. Views are that we're going to end up at a sort of 1.8 to 0.8 to 1% growth rate in America. That will, of course, have a negative effect on the dollar and a positive inflow into emerging markets. As regards China, it's a little bit more of a complex situation. We've seen low growth as a result both of the zero COVID policy as well as the housing crisis. Now, of course, we are expecting an opening up of the economy. They're looking at an estimate of 5% growth, which will be tremendously positive for emerging markets. But let's not forget the structural growth constraints that we're facing in China, the demographics, the high debt, the potential inflationary and deglobalization pressures. And then, of course, finally, the shifting of global patterns could have profound effects on emerging markets. The Cold War II, or the sort of East versus West situation, is likely to translate into completely different trading patterns. And consensus, I'd say, is that we're likely to see 2 blocks, a US-focused trading bloc and a Chinese-focused trading bloc. And how these come together will really determine the outcome. But certainly we are shifting to a slightly more positive than negative risk-on attitude to emerging markets.
André, higher for longer, that is what we're expecting. I mean, we're seeing rates at levels we've never seen before, and that can't possibly be good news for EMs.
Well, good morning. Yes, this higher for longer is what I expect. I think after 15 years of negative real interest rates using the dollar as a parameter, I think we went too far in terms of monetary expansion and fiscal expansion. And the consequence, all of us know, which is the highest inflation in the last 40 years in G7 countries. And I think markets and a whole generation of analysts, portfolio managers, economies, bankers don't know how to deal with that. So, including central bankers, I think we take too much time to start acting and repricing interest rates. But after we started, we moved in the direction. I think Fed is regaining credibility, but this process is still not concluded. I think in order to recover fully the credibility of the Fed, probably rates will stay higher for longer than markets expect. And markets are kind of trained for a quick recovery, right? To buy the dips approach, and that's what worked in the last 15 years. But this time, I think, will be slightly different. It's clearly inflation is easy, as you introduced it in our panel, but it's relatively simple to see inflation moving from 8-9% on the headline to much lower numbers. But it's not so obvious that core inflation will go back as easy as we expect to 2%, which is our long-term or mid-term target. So I think central banks, led by the Fed, will stay for a while at these levels of, let's call 5%, maybe a little bit more, a little bit less, for longer in order to make sure that their job will be done and the credibility will be back. Having said that, what is the key consequence, not only for emerging markets, but for global portfolio management? If you have 5% interest rates, means that a high-quality bank CD will pay 6% for a relatively short duration. And this is something new. What it means that cash is an asset class. And I think global portfolios are not adjusted yet for the fact that cash now is not burning. It's the opposite. You can park money there, relatively patient for a while. So I think this will be the spirit of 2023 discussions about portfolio management. Of course, that the important correction happened, as you listed in equity markets, some excesses. A good part of the crypto craziness over, excessive valuation in the tech market. So part of the adjustment was done. But I would say that, again, not only for emerging markets, but for global portfolios, we are still not adapted to the reality that cash pays you 5 or 6% for a while.
Who would have thought cash would be an asset class? They used to say, cash is not a strategy, right?
Yeah.
Ali, your thoughts? Have we seen the worst? Is the worst over for emerging markets? I mean, we talk about inflation. Turkey is suddenly one country that's looking at tremendously high inflation. 80% easing to 60%, it's still 60%.
Well, when we look at the last 20 years, there has been 2 periods of boost about the size of the balance sheets of the currency issuing central banks. The first boost was in 2008-2009 crisis, and the second boost of the balance sheets were in the pandemics during the COVID crisis, so to say. And so much liquidity at such a low price was not a sustainable thing. And finally, it hit the inflation, and central banks did the inevitable. I think it was important for the central banks to preemptively provide liquidity, because the pandemic could have made a huge impact in the global economy. So it was mostly prevented. But now it's time to just keeping acts together and normalize the things. Of course, this does have spillover effects to the emerging markets, developing countries. There could be future spillback effects to the developed world also. Of course, the emerging markets, developed countries, have to be very, very careful about what they are doing. For us, the monetary policy have been too loose for such a long time, and negative interest rates was too big. So that did have an additional impact on our domestic inflation. But then these are all reversible things. I mean, like former crisis, previous crisis, if the governments and the central banks take wise actions, inflation is not a dragon which you cannot fight with or something like that. You can deal with this. But most important element missing, which we have been observing over the last 1 year period, is lack of adequate coordination and cooperation across the countries. And G20 here is very much underutilized. G20 is a setup where 2/3 of the world population is represented, 75% of world trade is represented, and 85% of the global GDP is represented. And all the continents are represented. African Union is there, European Union is there. So in these very special circumstances, it is very, very important for G20 to come together more often. And now the digital availability is everywhere. And we all got used to using Zoom or WebEx, whatever platform it is. So G20 should meet more often to coordinate policies across the countries so that the reserve currency issuing central banks don't think that it is their only country or it is just the Eurozone, but it is the whole global village that we are living in. So more policy coordination is a must. And for the problems about Turkey, these are all easy to solve. It just takes good human resources, rational decisions to do it. And I believe that these could be fixed very soon. And Turkish economy also showed that there is the underlying resilience going on. Although we had lots of geopolitical issues, we are highly dependent on oil and gas imports. We happen to be in the middle of every single moving things across our neighborhood. But still on top of all these, the underlying resiliency is there. With better decisions, better actions, better being connected to the rest of the world, these are issues that can be overcome easily.
We'll speak about the opportunities in Turkey slightly later. You talk about the G20 leadership. Well, that goes to India this year. Let's get to Sanjiv. Sanjiv, still too early to be bullish EM, you think?
You know, when you think about it, emerging markets are far more accustomed towards high inflation, high interest rates. We've seen this happening periodically and much more resilient than the developed world. The developed world the last 30 years was used to a very low interest rate, very low inflation regime. I believe that emerging markets growth in this year is projected to be around 3.5% versus less than 0.5% for the developed world, and 4.5% plus next year versus again less than 1% in 24 for the developed world. Again, if you try to break down emerging markets, you see markets which are large domestic markets, you see countries which are large commodity markets, and then there are many others that are large export markets. And if we have to project out the next 12, 24 months, large domestic markets, and if at some point of time we talk about India, are starting to see significant growth. We've just finished 22 growing just under 7%. This year is projected to be a little slower in the first part of the year at 6%. 6% this year and then growing from there. We don't like it. We want it to be 8 and 9%, but can't complain at this point of time. What happened with China, and while China is opening up, the good thing to that is I think by the second half of this year, you start to see a boost to global growth. As China opens up, you'll see revenge buying hopefully over there. But the world is now looking at a +1 strategy. And we think emerging markets, we are starting to see that in Southeast Asia, markets like India, are waiting to grasp that opportunity. So I actually believe that the next 10 years can be tremendous growth opportunities for those markets that grab, for example, the +1 strategy very well.
I just want to pick up on China, Andre. China's reopening, how much does that change the investment landscape for emerging markets? Because emerging markets tend to look to China.
Yes, definitely it's a positive development, right? We all welcome, not only in emerging markets, but globally, given the relevance of China. I think it's good news for all of us. Some anxiety in the short term, like Chinese society is living through. But given all of our experience regarding COVID, probably in a couple of months, things will be better. Having said that, I think I want to make a more general observation about emerging markets. I think there was an important change in during the last, especially 10 years, about emerging markets, because as an asset class, I think changed a lot. Because, you have countries that have their own internal dynamics that are quite relevant for investment decision, like Turkey, or you could say Argentina. You have China, that is an asset class by itself. You have other countries that became uninvestable for geopolitical reasons, like Russia or even parts of Eastern Europe. And you have satellite countries around these situations. And then you have countries like India or Mexico or Brazil that became, let's say, the core of what we initially talked about emerging markets. This is one topic. The other topic is initially when we created this term of emerging market, it was all about growth. So it was a new asset class that would provide more growth than the well-known other asset classes. But I think this changed, even though that countries like India have strong growth, or even China, with all this acceleration, still has growth. But there was a change that is not very well explained or understood. Growth moved to another asset class, moved to mostly US tech. That's the growth area of the world. And emerging market became a more mixed group of players or alternatives or opportunities. And these opportunities, in my view now, with a few exceptions like India, they are now more value than growth. For me, emerging markets now are more about value. And I see the benefits of emerging markets as an asset class at this moment based much more on value than growth. We are in a transition from preference of global investments, which is reasonable. So we had a 15-year growth-driven investment story that is shifting to a value story. So if you look overall, as you described in the beginning, emerging markets didn't perform too much, currencies didn't perform too much, but when you look deep in terms of valuations, you have a very good yield offering, not only in bonds, but also in equity. So I do like emerging markets as a value asset class with a lot of world-class companies that are well-managed, good brands, good management teams, resilient, that will provide very good results, in some cases even growth. But I want to position it a little bit different than the traditional way, right. More of a value opportunity for global investors than only growth. Of course, again, we have patterns of growth, subsectors, countries, smaller regions, cyclical stories, China reopening. So we have growth in a lot of places. But overall, I think this is a transition. We had a growth move to U.S. tech space mostly. I think growth is investors are living out of this asset class for a while, and I think emerging markets are presenting as an alternative of value for this capital.
You talk about value, isn't it true as well that EMs are providing that value in an environment where people are looking at deglobalization, onshoring, friendshoring? It is the EM world, the EM countries that are benefiting from that.
Absolutely.
The likes of Turkey, the likes of India, the likes of South Africa. What opportunities do you see there?
Well, nowadays, there are many new areas of investment, especially renewable energy, for example, is something which is blooming all across the country, all across the world, including emerging markets. And lots of developing countries, emerging markets, they are actually happen to be having lots of sun, and most of them having a lot of wind. And especially if these projects are made by some support of the governments, like long-term credibility, assistance of the government somehow in some shape, then these also provide a huge new opportunity. So. Yes, the deglobalization is a reality, but when we look at the investments as long-term investments, not just short-term in and out, short-term opportunity, but long-term investments, then overall, the growth rate of the developing countries will be higher than the developed countries. So if the countries are chosen in a wise way, if you don't put all the eggs in one basket but diversify enough, so in the long term, on average, the investments in the developing world will have higher returns than the investments in the developed world. So that's, I think, very important for long-term view. Of course, there will be ups and downs. Emerging markets means risks. It means volatility. It means political instability from time to time, and it's in the very nature of it. But then, when you have that long-term vision, it's a win-win outcome. For renewables, by the way, for renewable energy, which is very, very important to reach the 2050 targets of net zero emissions, there's not enough financing yet. I mean, I happen to be in the 2015 group of UN for Sustainable Development Goals, 2030 goals. I also happen to be in the G20 eminent persons group for how to finance. But still, to reach the 2030 goals, the Sustainable Development Goals, the money is not there, and it is underinvested. And it is not going to be there. It is going to be a dream to reach the 2030 or the 2050 targets if we look at the financing for renewables as of now. So decarbonization investment is also a very important area, and how to finance it has to go through unorthodox mechanisms. The orthodox mechanisms is not working for financing decarbonization. And here, again, reserve currency issuing central banks should have a role. Because the currency they issue will not be worth a lot if our sons and grandsons don't live in a world where everyone is suffering. So it's time to use the powers of the central bank in a wise way, in a very targeted way, for financing decarbonization, for financing renewables, but it has to be done in a also globally coordinated way, so it's not misused, because when the central bank opens doors, of course, there will be lots of people demanding any kind of thing, but it should be strictly limited to decarbonization for renewable energy, and those specially opened central bank windows should be directed for financing. Otherwise, 2030 targets, impossible to reach. 2050 targets, impossible to reach.
Leila, EMs to benefit from the trends of deglobalization, friendshoring, reshoring, onshoring?
Sure, definitely there are opportunities for certain countries. I think what's different now than during the emerging market golden years in the early 2000s, where the rising tide lifted all boats, is that we now have far more developed emerging markets, and emerging markets are no longer a beta homogenous group of countries. So it's very much a heterogeneous group of countries, and those countries who are able to play on the key things that would drive deglobalization. Firstly, commodity production. I absolutely agree with Ali that green commodities will be a critical trade growth path driver. The resilience that is being built into supply chains, together with, importantly, energy diversification, will drive new trade relationships. And of course, the ability for certain emerging economies to provide commodities at a more efficient price will drive new relationships. As a more recent and non-green example, our Thungela, our coal company's share price since the beginning of the Ukraine war has increased by 101%. So we are already seeing an immediate knee-jerk shift, a domino effect, but the real question is, how will those long-term relationships shift? I think we've seen a sort of global south, global north shift happening, but what we are seeing now is more of an east and west shift. And many of the countries emerging market countries are well positioned to actually serve both, particularly GCC countries in the oil environment. In the commodities environment, you've got sort of two themes or three themes going: oil, metals, and then the green commodities. And all three of those offer tremendous beneficiary opportunities coming out of the reclassification and redevelopment of global relationships.
Sanjiv, what are you seeing in terms of those shifts and how EMs will gain from it?
You know, there's an important thing to keep in mind. Building supply chains, especially in manufacturing, takes years, if not decades. So nobody's leaving China. But because of what's happened over the last few years, incremental capacity building is where emerging markets have a huge opportunity. And you will see a reorienting and a rebuilding of global supply chains over the next decade or so. But it's very important that emerging markets have stable and progressive and transparent policies. Because if you're going to see new companies, new investors coming in, for example, Apple came into India just 3 years ago, is already doubling production every year, making it one of the largest bases for iPhones and now adding computers. But they want to make sure that the next 10, 15, 20 years, policies will be stable, progressive, and emerging markets will have to compete with each other. So I think that's something very important to keep in mind. Second, when you look at different emerging markets, one must try to understand that what's the competitive advantage? Is it people? Is it talent? Is it raw material? Is it location? Based on that, particular industries will move to particular countries. And third, of course, and you talked about friendshoring or nearshoring. So geography will play a role and political relationships will play a role. So a combination of this, I think, is going to make things very interesting over the next 3 to 5 years to see where the new capacities get built.
I think it's quite interesting that you brought the point that transparency is important, stability of policies is important, and these are exactly the kind of things you don't see normally in emerging markets, and therein lies the risk. I mean, let's take Brazil. I mean, people are looking for greater political clarity. They're also looking for greater economic clarity. How do you make sense of what's happening in the country?
Yeah, well, just before we go specifically to Brazil, I want to make a comment regarding this global supply chain restructure or potential restructuring. We are from a generation that we collected fully the peace dividend. Since the Berlin Wall fall in '89, global supply chains were organized based on one, by far, most important target, which was efficiency. And this was quite beneficial, not only for emerging markets, but for the whole planet, right? I think benefited China, South Korea, India, Mexico. So a lot of countries that improved a lot the quality of their societies based on that. This was quite good. Eventually, I don't think this finished. I think supply chains will still be driven by efficiency, but we will add other factors to that. And these new factors are basically new sources of, new demands of security. Could be, of course, the most basic of all, geopolitical security, but also energy security, cyber security, environmental security. So other sources of priorities will join efficiency in terms of restructuring of global supply chains. And this, I think, is an opportunity. With the tensions in Russia, Ukraine, tensions, China, Taiwan, there will be some sort of restructuring. So countries, as was said here, that come with transparency, have scale in the right geography, the right geopolitical approach, certainly will be benefits from this. Not on a dramatic way, nobody will leave China in one way or the other, but some sort of restructuring will happen. And the second factor, which is an economic factor, is still, in my view, not totally factoring in geopolitically or economically, is the weaponization of the dollar. I think we have still a challenging agenda ahead of us in terms of deleveraging central banks. And in a context that dollar became a geopolitical instrument, right, more than any other moment in history. So the Fed still have roughly 9 trillion of U.S. treasuries that will reduce by many trillions in the next couple of years. But maybe, I don't know if China will be the buyer of these additional sales. Maybe it will be a seller together with the Fed. And I don't think this is factoring in the financial market prices. So that's to add on this geopolitical reorganization. Specifically regarding Brazil, I think institutions are quite strong. And you asked me before about the events 10 days ago. We had a small version of Capitolio events 2 Sundays ago. But the good news is how fast the institutions' reaction, and it was a completely isolated event with all the political leadership, including the rightists, the leftists, the center, the media, the Supreme Court, the business community, the markets. Everybody came, including President Bolsonaro, in the defense of the institutions. So we have in Brazil a very sophisticated, transparent voting system. So simple elections that in less than 24 hours you have full results, and we had a winner. So power changed from right to left. Eventually we'll come back to right, we'll stay for left for a while, as it happened in the last 30 years in Brazil. So I'm very bullish on our...
How about in terms of economic clarity in Brazil?
Economic clarity, I think, is more of a reasonable challenge. Institutionally speaking, I don't think there is any risk in Brazil. Economic clarity is, well, we have a new government. We are changing policies towards more classical leftist policies, and we need to understand fully the new plan. Of course, we have some guidelines. President Lula was president for 2 mandates in Brazil. It understands the logic, his responsibility, was fiscally disciplined, and he was in office for 2 mandates. So it's no reason to worry, but of course, markets will demand more clarity, understanding the middle-term plan, and I think I don't see any issues. The fundamentals are quite strong in Brazil, I would say, at this time. We had growth, we had 6 years of structural reforms, very good social security reform, good labor reform, number of concessions, independent central banks, so a number of what I would call economic institutional evolution that now are partially priced, and I think the new government will just try to move from this moment to another layer of development.
We talk about fundamentals. Suddenly those fundamentals are being questioned in Turkey. Add to that the risk from the looming election. How should investors be looking at the potential and the risks in Turkey?
Well, we have elections on 14th of May, and I am the leader of one of the opposition parties. And what we are going to see before the elections would be probably more of populist approach. That's inevitable. But then for after elections, if there's a change of a government, and it is very likely to be so, then probably there should be an expectation for better human resources and a more rational approach of what is being done on economic and financial management side. But just not for Turkey, but for many developing countries, what is, at the end of the day, what's important is a rule-based approach when it comes to policy set. We have mainly 4 areas, right? The monetary policy, fiscal policy, macroprudential measure area, and the structural reforms. For the first 3 areas, for the monetary policy, a rule-based approach for central banks is very important to bring credibility, which means under which circumstances, what kind of an action the central bank will do, and announcing this to provide also a forward guidance for the markets that under each scenario, what kind of acts the central bank will do. And pre-announcing this is going to give very important guidance. And for the fiscal policy, fiscal rule is very important for the developing countries. It's difficult. Even the Eurozone came up with a fiscal rule after 2008-2009 crisis. They had to come up with a fiscal rule. But having a fiscal rule is also very important for developing countries to bring predictability to the business world and markets. And then macroprudential measures, using the banking regulation in order to tighten or loosen credit availability. Of course, it's a very complicated area. There are many, many tools that you can use in that area. But again, a rule-based approach for macroprudential measure set is very important. So if there is a rule-based approach for monetary policy, fiscal policy, and macroprudential measure set, this will bring a huge amount of predictability about what will the government do, what will the central bank do, under which circumstances. But the big problem about a rule-based approach is the fact that the political leaders sometimes don't want to be bound by rules. They want to have always choices in front of them. But it's a choice between vulnerability, volatility versus stability. Yes, it limits the choices, but at the end of the day, it benefits the country.
Sanjiv, how do you capitalize on the opportunities in India? It grew 6.9% last year. Set to be a $7 trillion economy in 7 years. At least that's a target. I mean, how do you capitalize, maximize the potential?
Very clearly, what the government has done through the last few years, one is through the pandemic, realizing that private sector investment could be low, there's been a significant increase in government infrastructure spending, roughly $100 billion a year, which is massive for a country like India. And we are starting to see a new India there. Second is the government has identified initially 14 sectors in which there are production-linked incentives, starting with sectors like auto and auto components, where India has been strong traditionally, to newer sectors like green hydrogen and electrolyzers, electronics. So it is attracting investment. Ease of doing business and cost of doing business. Improvement in both of these is a significant priority for the government. We are also a federation, so the central government is trying to work very closely with the states. We have a new national single window system for all kinds of clearances if somebody wants to set up a new project. In addition now, with growth coming in, pandemic seeming to come under control, we are starting to see early signs of private sector investment coming in. Our banks are very well capitalized, ready to lend. So all the ingredients are now in place. And I believe the +1 strategy, plus a very large domestic market. We are already today the 5th largest economy in the world. We are the 3rd largest auto market in the world, the largest motorcycle market in the world. 1.4 billion people, half of them are consuming all kinds of things every day. India now, a lot of people don't know, accounts for 40% of global digital payments monthly. 8 billion transactions a month is currently the run rate. My own company, we do loans and insurance. We roughly issue 100,000 loans a day, 200,000 insurance policies a day. 99% of that is digital. This is the new India. And this is the promise and the reality for the coming years.
We have about 7.5 minutes to go. We're happy to take questions from the floor. If you have any, you can just raise your hand, and I believe there's a mic, at hand. And any questions for our speakers?
I'm interested in regional geopolitical tensions. And you touched on that at the very beginning of your opening comments about geopolitical tensions as being something that ultimately is a disincentive for FDP kind of going into certain emerging markets. But nobody's really kind of touched on, for example, China, US, Russia, China. I'm wondering where that all lands in the EM.
André, would you like to take that question?
Well, I'm the easiest one to answer. I will let my Turkish and Indian colleagues to talk about that. But well, in Latin America, you don't have any geopolitical tension. It's a Pacific region of the world, and strong commerce among countries, friendship. This year, most of the Brazilian population even supported Argentina against France in the World Cup final, which is a key geopolitical development in the region. Having said that, Latin America, as we spoke before, based on the geopolitical restructuring, could be a beneficial given the peaceful nature, and not only in terms of geopolitics, but also in terms of natural resources, right? It's the largest food producer and especially food exporters of the world, also net exporter of energy, next exporter of minerals. So it's based on these characteristics, plus certain level of institutionalization and scale at the end of the day. Brazil alone is 220 million people. It's Latin America as a whole, 500 million people. So we have scale, you have natural resource, and you have peace. So it's in this context, I think it's also a good recipient of especially long-term FDI.
US-China tensions certainly benefit India. India does not want to get dragged into it, and it's benefiting in a way, isn't it?
So, we have an interesting border. We have Afghanistan, Pakistan, China. So it doesn't get more exciting than that. But what we are seeing
Maybe
is...
you should ask your Turkey colleague about that.
Exactly. But what's also interesting is, and we are seeing India take this position, is you'd expect most markets to either be in the US club or in the China, maybe Russia kind of club. But India has been standing separately to say that no, we'll create a set of relationships that are meaningful to us. We've had long-standing relationships with Russia. We get blamed for that right now. But they've been long-term partners. But on the other hand, India has very strong relationships with the US in the last few years. Even though there is political tension with China, but we continue to buy a lot from China because business relationships don't die overnight. You have to keep rebuilding it, and political relationships could change. So we see at least a country like India having the ability and the humility to be able to forge a set of new relationships which will help to bring in, we think, greater peace, but greater business opportunity as well.
I think the key point here is that while the war has been tremendously polarizing, the BRICS countries do have a legacy trading and historic relationship with Russia. And if we just look at the UN voting in the most recent situation with Russia and Ukraine, 143 countries voted for and 35 countries abstained. I think the key impact will be, and André alluded to this, focused on food insecurity and energy prices. Those countries, many of whom are emerging markets that are net exporters of food, like South Africa, are set to potentially gain. Those countries who are less dependent on gas, South Africa in this instance is more dependent on coal for energy, on a relative basis is likely to gain. And of course those oil exporters, many of whom are emerging markets, are gaining tremendously. So I think it depends on A, the legacy relationship, and B, the food and energy position.
For the geopolitical tensions, it could be at global level, like China, US. It could be at regional level, like Ukraine, Russia, Europe. It could be at bilateral level. But the question about China and US is also about a huge interdependency, economic and financial interdependency. And when the economic and financial interdependency is big between countries or within a region, then it becomes a very important insurance for better political relations in an inevitable way. So this link between China and the US is, I think, big enough for both countries to motivate them to have as good relations as possible, as long as possible. And President Biden's meeting with President Xi was probably a very good step forward, because coming together, talking, solves an important part of the problems. Being able to talk even under very difficult circumstances, keeping the diplomacy channels open under difficult circumstances, keeping the business community channels work is also very important. Putting the business community in charge, like the business organizations we have in India, Brazil, in Turkey, South Africa. So these organizations could have a major role in convincing their respective governments that, well, we have interests, so let's be careful. So these are, I think, all very important preemptive ideas to prevent the damage before it happens.
We can take one more question if there is one. No?
I probably just have one question regarding the debt level of the emerging markets, knowing that the bulk of the debt has to be dollar denominated.
Could you have the mic?
It's just how big of an issue is the debt level of the emerging markets, especially the ones that are dollar denominated, and knowing that the interest rate is actually going up, so that will have an impact on the service level of the debts.
The question, I'm sorry.
As regarding the debt level.
Debt level, okay.
Debt levels.
Okay.
Yeah.
Surging debt level for emerging markets.
Do you want to go?
Please.
Thank you. So certainly debt levels are a critical consideration, and I think a confluence of the pandemic, the Ukraine war, together with the inflation surge, have caused emerging markets' debt to rise, and the difference between the emerging markets and the developed markets has increased. Particularly the countries that are most affected are low-income countries. South Africa, as an example, is in a much better position now than they were prior to the pandemic. In fact, it's the only emerging market country, one of the only emerging market countries that has a better debt position now than prior to the pandemic. Those elements that will affect the debt will be, of course, commodity-rich countries who have had a windfall of tax and able to deploy those tax benefits for debt consolidation. Of course, over the recent past, with the rising dollar, the debt levels have increased. As we come into what would hopefully be a soft landing and the dollar devalues, that will of course provide some relief. But that said, I think there is a structural shift which is creating a mismatch and increasing the divide between the developed world and the developing world in debt levels and affordability to repay that debt.
Yeah.
Well, actually, public debt is not just about the level, about where it is today, but it's about how it's going to act, the trends. We call it public debt sustainability, which means 5, 10, 15 years from now on, public debt to GDP ratio, private debt to GDP ratio, how are they going to act? And it's a function of real interest rates and growth rates. So with low public debt, for example, low growth and high interest rate could actually take the country's debt level to a very wrong, very dangerous position, or even with a very high debt level, but with good amount of growth, with lower interest rates, it could be a totally different thing. And here, of course, fiscal policy is a key, another third parameter. So putting all this together and looking at the debt sustainability analysis under different scenarios is probably a better way of looking at it. And emerging markets have very different public debt sustainability outlook when we look at what they are doing. So it's more of a country-by-country analysis, which is needed. It's very difficult to put an overall analysis on top of all the countries.
On that note, we have to wrap up the discussion. Ali, Leila, Sanjiv, André, thank you so much for your time today, and thank you for joining us.
Thank you.